The Nigerian authorities are looking at going back to the markets sometime, perhaps if we can still do another Eurobond before the year runs out. But if you look at the yield at issue and the yield and the current yield for Nigeria sovereigns, out of these 5 sovereigns that we have out there, the longest is year 2032, which was the one we floated in February. In February, yes. In February this year. And you're looking at the yield at issue and the current yield. And if you take it even way back to what we issued in 2013, it looks like the yields are coming down. What does that tell me as an investor?
Well, if you know, yields and prices have an inverse relationship. So in a situation where you have yields coming down, it means prices are going up. And this is a positive sign. I mean, for an instrument that was, yield that's issue was about 7.9, which is down, current yield is about 6.7, which shows that there's been a lot of buy interest. And even in terms of looking at year-to-date performance of this instrument, year-to-date price performance is up about 7.7%. I mean, almost all the Nigerian instruments are actually up year to date. Similar for most of the other sub-Saharan African Eurobonds. But the best performing year to date in terms of price change is the Kenyan instrument.
Let's move on to the corporate side of the corporate Nigeria corporate Eurobond. We have about 7 banks: Access, Diamond, Fidelity, First Bank, GT, UBA, and Zenith Bank with their corporate bonds with various ratings out there. If you look at the yield on these instruments, some of these yields are 1, 2, 3, few steps higher than the sovereigns.
Yes. So for the fact that it's a bank and looking at the credit rating of the country in which the bank operates, it's expected that investors would require a premium on a higher premium than they would require if they invest in a sovereign. So this is one of the reasons why we're seeing higher yields on these instruments. Also, considering the fact that the challenges we had in the market and the impact that it had on performance of some of these banks in prior year, we saw a lot of sell-offs across some of the Nigerian corporate Eurobonds, the likes of First Bank and Diamond Bank also, as well as the Fidelity instrument. But since the turn of the year, we've seen a lot of investors take significant position in these instruments because they were trading at a significant discount to par, and now we've started to see a lot of traction in them. I mean, for the Nigerian corporate Eurobonds, the best performing in terms of year-to-date price gain, you have the Diamond 2019 as well as the First Bank instrument. So it shows that there's been that interest in these instruments, which is positive.
When you see increased corporates at the global DCM window, what does that tell about the position of the economy in general, the state of the financial services industry, some concerns at some point by folks about the stability of the banking system?
Well, it's a general positive in the sense that now they have the confidence to go into the market. We know for a greater part of 2015, 2016, we didn't really see any banks come to the market to float any euro bonds, but just this year alone, we've seen Zenith Bank, we've seen UBA also, which is also positive, which shows that the situation is improving and is generally getting better.
Yeah, very interesting. I just took a look at the table, and I can't find any 2015 Eurobond at all. That looks like a watershed year for Nigeria.
Exactly.
We saw 2013, that was from Fidelity, from First Bank, and from GT Bank. 2014, yes, we had a couple. Access Bank was the only corporate, yes, that did an issue towards the end of the year. That was in October, almost a year ago, that Access Bank did that $300 million US. So 2015 was particularly, no one wanted to go to the market because even the Nigerian government could hardly go to the market in 2015.
Exactly, with all the challenges that we're facing, especially tied to FX illiquidity, it was a major deterrent towards coming to the market. I mean, even confidence levels were rather low. So there's that likelihood that any bank that might have come to the market would have had challenges with actually raising the needed funds.
Now we have a stronger buffer in terms of the FX portfolios. We have a very decent capital importation from outside, despite some concerns about whether these are hot monies or whatever. But do you see where we are in terms of our fiscal position as a basis to say, well, look, we expect more of these corporate issues moving into the end of the year, moving into 2018, before we run into the 2019 election, stormy waters. Our elections are always stormy anyway. So before we run into that, do you think we have about a year window or year and a half for any of these corporates to say, look, for Access, for example, we've redeemed $350 million US. Let's quickly go back to the market and make some other, bring in some cash, because we need to stabilize what you call our capital position. We need to expand, we need to upgrade, we need to do a few things and be more resilient for an economy that is just trying to see a glimmer of hope from recession.
Well, we strongly believe if the need arises for any of these banks to raise additional foreign capital, they have that needed impetus. If you talk about the fact that we've seen the FX situation improve, there's that confidence that they can come to the market and actually raise the needed funds. So we could see more of them come to raise within the end of this year and even at the start of next year. Although from a capital base point of view, most of the banks, especially the tier 1 banks, are adequately capitalized to meet their obligations. They are also in line with regulatory guidelines on what their CAR should be. So if the need does arise, then we might see some of them come.
We'll have another conversation another day, maybe with you, when we look at these corporate issues from the non-bank and why we hardly have any from our own jurisdiction out there at the Eurobond market. Thank you. And that's the man from AfriInvest, of course, one of Nigeria's investment and securities firm that had a bond tied to the Brady bonds, if you were in the market, that was 20 years ago. We'll come back after the break. We're going to look at making Nigeria and made in Nigeria. What do the government really want from the private sector, who are angling to say, patronize us, don't shop for goods from the outside? What does the government really want from local manufacturers? We'll take a look at some of this after the break.